Hey everybody, welcome to the second part of our chapter 1 and 2 work. What we're going to do today is just going to go back over one of the problems. We've had a couple of questions like the problem 1-1A, it's going to be on page 40. 1-2A, it's on page 40 and continues into 41. We talked last class period or last video about the modified accounting equation, and that's really what they want you to focus on this. You're going to be assets equals liabilities plus owner's equity plus revenue minus expenses. All they're looking for. What we're going to do, though, is that in each one of these, we're going to get a little bit more in detail. So what did we say assets were? We said assets were anything of value owned by the business. Liabilities were the debts of the business. So, for example, accounts payable, bonds payable, notes payable, salaries payable. And our key word is payable. Owner's equity is the owner's investment in the business. Like if I take my personal assets, give them to the business, it's going to be owner's equity. Now, depending upon corporate structure, that could also be common stock. But for the first couple of chapters, we're going to only focus on that being capital. Plus revenue. Revenue is our sales. It could be our service revenue. It's basically the value of the goods that we're performing, the value of service we're performing. Traditionally, if I'm selling a product like Diet Root Beer, you'll take the selling price, we'll call this $1. If I sell 100 of them, that means your sales will be $100. It's the individual unit price multiplied by the quantity, and that's how we arrive with sales. Expenses. Expenses are normal, ongoing operational cost of the business. That's people expense, wages expense, salary expense, cable, rent expense, marketing expense, advertising expense. I mean, just those four parts. And then minus withdrawals, withdrawals is basically the exact opposite of capital. That's when you take money out of the business for your own use, right? It's just the exact opposite of capital. So let's do part of the problem together. So very first one. So first thing I want you to do is I want you to get a piece of paper. I want you to turn it long ways, just like that, long ways. Assets equals liabilities plus owner's equity plus revenue minus expense. Give yourself more space for your assets because they'll take a lot more space up. Now what we do is we read each transaction. We're going to go under its proper category, and then we're going to write the account that's impacted. Now the primary ones you'll see is like cash and AR. We'll talk about those as we do it. And you're going to continue making the adjustments straight down the line, and then at the very end, you're going to add all this up, and you're going to tell me total assets, total liabilities, total owner's equity, total revenue, total expense. First one, invested $15,000 cash to start the agency. So what we're going to have, cash is going to be increasing $15,000. So under my assets, I'll go and write the word cash for $15,000. And what else? Well, we know that anytime an investment occurs or somebody takes their own personal assets for the business, it will go into capital. So I'm going to have $15,000 cash, $15,000 capital. Paid $600 cash for April office rent. Same transaction. Cash is going to go down by $600. Rent, of course, rent's a rent expense, so you'll see cash down $600, and under expenses, you want to be very clear in your expenses. Don't just group them in expenses. You want to be very clear. You want to call it rent expense $600. Okay, good. Purchased equipment for $3,000 cash. Same way, right? We know assets are anything of value owned by the business, and equipment has value. So I'm going to reduce my cash. Cash will go down $3,000, but equipment will add a new account called equipment, and it'll be up $3,000. Pretty easy. Number 4, incurred $700 of advertising expense, Chicago Tribune on account. Right? So when we see something like that, and we see our magic words on account, that's going to tell me it's going to be an accounts payable. Accounts payable. Okay. So what we're going to do, we're going to have a debit to advertising expense. I should say advertising expense is going to increase. We'll talk about debits in chapter 3, but advertising expense is going to increase. Okay. And we're also going to see our liabilities, and under liabilities, we know that's debts. Specifically, I'm going to call this one accounts payable, and that will be for $600. Inside of liabilities, we have a whole bunch of them we'll talk about through the course of the year. The big ones I want you to focus on so far, let's stop my Roomba for a moment. is going to be accounts payable. Accounts payable normally only exists for 30, 60, 90 days. It's short term. It's buying something you don't have cash for. You're utilizing payment terms. It's always better for us to go through and have access to goods that I can sell and then pay for them 2 months later, 3 months later. Always better to do that. Sometimes the businesses are really bad shape. The customers will put the business on cash on delivery. That means you got to pay the cash before you can get the product, and that is like a kiss of death at that point. Because what that means is, like, if you have the float, right, if you have the ability to get goods and you can sell them for 30, 60, 90 days, you can generate the cash. So when finally it comes due, or 30, 60, 90 days, you can pay this person off, but you also have obtained a profit. So that's great. And you can use that profit either to, pay some expenses or whatever it may be. But ultimately, really though, when you're cash on delivery, it's bad, because that means you can't buy anything without having the cash outlay. And once the cash outlay is there, it's done. Your cash is there. You can't use it for anything else, right? Because once your cash goes out the door, you can't write more checks on it. It just doesn't exist. So we prefer to, as where possible, only deal with stuff like we buy stuff on account. Perfect world. Most companies have an average of 30 days. Some vendors may require 7 days. More recently, Anheuser-Busch, probably about maybe 6 months ago, Anheuser-Busch went to a program where it said, vendors, we're going to pay you in 120 days. Right? And what that really means is that Anheuser-Busch doesn't have to pay them for 4 months, which is great, right? They're able to get the product, they can sell the product, they can bring the money in, they can pay expenses, they can do other stuff with it before having to worry about paying the vendors. It's pretty awesome. Most companies, Coke was 90 days, Phillips was 90 days. Pretty much everywhere else I've worked at's been between 30 and 60. Anyway, back to work. Sorry about that. Yada yada. Number 5, paid $900 cash for office supplies. Same exercise. Cash is going down $900, and you're going to add a new account called office supplies for $900. Number 6, same exercise. Perform services with $10,000. $3,000 cash is received from a customer, and the balance 7 is billed to customer on account. Okay. So cash is going to go up 3. AR is going to be 7. And then total sales is going to be 10. So it's going to be cash, 3, AR, 7. All those are under assets. And then under revenue, you're going to have the $10,000 we showed right there. Now, one thing to keep in mind, there's only 2 reasons why we ever sell a product. One is to get cash in hand immediately, and the second is to have that promise that somebody's going to pay us cash. So any transactions you're going to deal with, 99% of the time, you're either going to have a debit to cash, credit revenue or sales, or a debit to AR, credit revenue or sales. 99% of the time on that. There are some barter transactions that exist, but hopefully we'll never have to end up doing any of those. Yada yada yada. Number 7, withdrew $600 cash for personal use. Cash goes down $600, and withdrawals is also adjusted by $600. Paid Chicago Tribune $500 of the amount due in transaction number 4. So we're back and forth where we put the $700 on account. Right now we're coming back and paying $500 of it. So what we'll do is our journal entry will be a debit to liabilities, credit to cash for $500. That will be a debit to liabilities, current liabilities, accounts payable, $500, and credit to cash. I'm going to let you go ahead. There's 2 more on that transaction. I want you to finish those up as just part of your homework. Same thing from problem 1-2A. What they're asking for is they just want you to come up and calculate net income and loss. So prepare just the financial statements for the income statement, the statement of change in owner's equity, and also the balance sheet. All that. Super easy. Just look through those. Real easy. As we go back through, we're going to look at chapter 2. Probably I'll put another video out probably in about an hour. It'll be more so on chapter 2. We're going to get more so to the debits and credits. So that'll be next. Okay, bye.